Welcome to the Whitwam Wealth Real Estate Podcast. Today's episode is Measure Twice, Cut Once.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam. Today we'll be talking about measuring twice and cutting once. Today, I'm not primarily talking about remodeling our properties. Today, I want to talk about some mistakes that are commonly made by investors in tight real estate markets. The saying, measure twice and cut once, is about being conscientious. And I think that there are times in our real estate investing businesses where we really need to be conscientious. We really need to think things through. And so my first point is evaluate. We really should get good at evaluating. And so what I have here with me is a tape measure. And we use a tape measure for measuring, evaluating the space. We can use it for measuring lumber. We can use it for measuring how big a room is, for measuring how large our furniture is and how well it'll coordinate and fit inside of a room if you're staging or if you're doing a furnished, pad split, co-living, Airbnb. All of these things are important. We need to measure. And so a tape measure is used for measuring. But we also use something like this. This here is also a tape measure. It's a different kind of tape measure. It's a tape measure for what the market looks like in comparison to the property that we are evaluating. One of the things that happens a lot of times in tight real estate markets is we go into them thinking that we're in a good real estate market, that we're in the same market we were in years ago, and it can be dangerous. Even though I'm a big proponent of where the market's going to be by the end of the year this year, that is all speculative. It is very much dependent upon government policy, which I think are headed in the right direction. I think we're starting to see a pullback on government-produced money, which is lowering inflation. We're starting to see more private sector employment. We're starting to see a lot of consumer price is looking good. The numbers are starting to look good in several different areas. The labor participation rate, all these things are things that we use to evaluate where we're going. And so it's important that we take our tape measure to our real estate investing business in the form of our evaluation sheets, and don't just dive headlong into a speculative market, but that we really start to focus back on our evaluation. Sometimes I even tell more experienced investors that I'm working with is go back and remember when you first got started, how cautious you were with your first couple investments. You didn't want to overpay. You wanted to make sure you had enough room to sell. You wanted to have enough room for repairs. You wanted to make sure that you would have debt coverage on a rental property, whatever it is. Go back to some of those things. And so let's get a little bit overheated in the evaluation market. Now, you don't have to take a super long time to do this. The more experience that you get at this, some of you investors have been doing this a long time. I know that you're pretty fast at this, but that you can measure twice, that you can run the numbers and then maybe run them in some alternative systems to make sure your numbers are good. Only takes a couple extra seconds, but you can certainly knock it down. Now, if it's the first, time you've done it, or the first, 10th time you've done it, or whatever, and you're still, kind of getting your walking legs and pace, take some extra time. You're better to lose a bad deal than to purchase a bad deal because you didn't properly evaluate. So I think spend some time on evaluation. My second point is also in the area of evaluate, but this one here is evaluate more exit strategies. If your exit strategy on every property that you purchase is to buy and hold, I would say look at several exit strategies. I mean, we do that on all of our investment acquisitions. We're looking at, is this thing, what is our exit strategy if we flip this property? What is our exit strategy if we make this a short-term rental property? What is our exit strategy if we wholesale this property? What is our exit strategy if we make this a long-term rental? I mean, what is our exit strategy for the property? Now, we take a little bit more time and we develop multiple exit strategies so that we know that if for some reason we miss on point one a bit, or the market changes on us mid-rehab, or the market changes on us right after closing, or whatever the case may be, that we have additional exit strategies to move or occupy the property that we are purchasing. This is something that we focus a little bit more on in tight real estate markets, because there's nothing like getting a property. You've done your evaluation on it. It looks perfect as a flip property, and the market even takes a more adverse direction. For instance, interest rates go from 6 to 7 to 8. What if interest rates hit 9%? What are you going to do with the property? Because it certainly is pulled back as buyers have been with interest rates where they're at and the mortgage bond rates where they're at. You raise a couple points on that interest rate and more buyers are going to pull back. It's going to take some time for that to settle into the marketplace. And so what you're going to have to do is, what do I do with this property? Well, can I now turn it into a hold property, whether it's a co-living, whether it's maybe the Airbnb model, or maybe turn it into a long-term rental property until the market conditions change and you can fulfill your initial exit strategy. So my point number 2 is evaluate more exit strategies. Don't be locked in to one way of thinking or doing things. And I know this is sometimes very tough. If all you've done is buy and hold properties, it may be tough for you to go, well, this just isn't a market. Evictions are up, rental prices are down, the market's beginning to flood with rental properties. And this is what would happen if the sales side of things slow down. I think you're going to find that more people move into this area, because right now it's still pretty decent, at least in the areas where we are. And you're going to have now more competition on it. So now do you look at, okay, well, what could we do? Could we do a lower end remodel on this property, not spend as much money to make it, grandiose, and still be able to sell it, get out of it, and make some money on it, and move on to another property? So we need to evaluate more our exit strategies. Point number 3 is we need to get better at making compelling offers. In tight markets, our offers have to be more compelling. Why? Because generally they're going to be lower in relationship to the tough market. If in a great market, properties are selling on average in 14 or even 30 days, you know what your time frame for holding that property is going to be. And if you're using hard money or you're using investor funds or one of those type of things, you may be paying, 10, 15, 18% on that money, or even maybe 20% on that money. If you know you're only going to have to hold that property for 30 days and you can rehab it in 30 days, you can build 60 days of interest into your project. But now we get into a tough market where the average days on market, we'll say, are 70, 80, 90, maybe 120 days. Maybe you're in the Midwest where an average days hold in some of those areas are 6 months. You have to make a more compelling offer to adjust for the interest rates that you're going to have. And this is why I say it's important to measure twice, to look at all these things a couple of times to make sure that your offer is compelling. And so one of the methods we use and that we teach in our real estate investor coaching program is how to show a seller a systematic offer. So we'll take and say, because we have multiple options, but we take to them and say, hey, look, if you remodeled this, put it on the market and sold it yourself, you would get X amount of dollars. We'll say $500,000. However, if you sell it to us today, we take all the risks. We do all the rehab. We do all of the repairs. That's going to cost us $150,000. We have 2 closings with you, closings when we sell it, if we're going to flip this thing. And therefore, our cost will be $350,000, and we need to make 10%. So we may need to buy this house for, we'll say, $315,000. And we show them and give them the options. We tell them if they want to rehab it, remodel it, and put it on the market, we'd be glad to help them as a real estate agent. If they'd love to rehab it, we'd be glad to help them as a construction company. But if they just want to sell it, eliminate their risk, let us take all the risk, let us put up the money for the rehab, let us worry about marketing it, selling it, and we go over the days on market. If days on market are on average 80 days, they're 80 days for the seller you're talking to just as much as they are for you. And so we use that in the compelling offer. We tell the seller that, look, you can remodel this thing and get the $500,000 for it yourself. The rehab is going to take 60 days. So you have 2 months of the property being under construction, and then average days on market are 80. There's another 2.5 months. So your sale date really is going to be 5 months down the road, because once you get under contract, you've got typically a 30-day closing on retail properties. And so you're looking 5 to 6 months to have this property sold to be able to recapture the money that you're going to now invest in the property. So we make this offer compelling for as to why they should sell to us now. By knowing our exit strategy, by evaluating the properties, then we can make better, compelling offers. And I think that's really important. We find good results in tough markets when we can show the full picture to a seller and let them make the same decision that we have made for them. And it works really well. And from our standpoint, any of the scenarios that they pick that they engage us in is a win for us, but certainly we rather have the acquisition of the property. That's where our main model is. Okay, our point number 4 is get your stuff done quickly. In a good real estate market, when things are selling in 2 weeks or 4 weeks, you can drag your feet a little bit getting stuff done. Part of your evaluating and figuring out your costs and stuff is figuring out how quickly your contractor or how quickly your team or how quickly for some of you can get the work done to get the property ready to be marketed. Doesn't matter whether you're, flipping the property. Doesn't matter whether you're doing some type of buy and hold, whether it's long or short term. Doesn't matter. You need to figure out how quickly you can get this done to get the property in the condition that'll best market it. Because this here can be a killer to somebody if you haven't checked with your construction crews, you haven't figured out where they are in the marketplace, you don't know where your supplies are, and you acquire a property, and instead of it going to be 60 days to be on market or to have the for rent sign out front or to have it online as a short-term rental, you find out that it's going to be 6 months. And with changing markets, your market could go from tough to really tough. So you want to get things done quickly. You want to preserve your capital. You want to make sure that you're in a position so that you're ready to go and move once you do get the property under contract and close on it. Don't eat up all your profit if you can, dragging your feet. And I know sometimes when you get multiple properties going, for some of you who may do a dozen, flips a year, you get into a position where you've got 24 flips a year, you got twice as much work. But if you're working with the same teams, they may not be able to get things done as quick as you're used to doing, and it really can get expensive and change the bottom line and the profit. So again, our evaluation up front makes a big difference. If you're thinking about doing land development, this all applies, but right now in the marketplace, in the market where we are in most of the areas here in the U.S., development is a little bit tough because with interest rates where they're at, there is not the competition that you want for the acquisition of the new properties, the land or the developed brand new properties. We're seeing new home builders slowing. We're seeing new permits slowing. So, I would say if you're doing land development, that's your business, that's your investing model. Just apply these same principles. Just be very, very cautious with your days on market and your time to have your construction done. If you're in this industry, there can be holdups at permitting, at zoning, at planning, at getting your subdivisions done, all of those things that can add days and really affect your project. Point number 5, get it occupied or priced appropriately. So once you get the work done, you get it occupied as quickly as you can. You're better to do in a tough market. You're better to do, either a better price point for somebody signing a long-term lease, so maybe a 2-year lease instead of a 1-year lease, to get them locked in for 2 years at a set price, or do a very short lease, a 6-month lease with favorable terms that adjust in 6 months. Or if you're bringing a property on the market, find out what the other rehab properties in your area, what the resale properties are. Again, you're going to be doing evaluation and look at how you can price your property appropriately. Now, I know as an investor in a good market, if properties like mine are in great shape or just been, rehabbed, are on the market for $500, I might want $509 or $519 for our properties because we try to rehab wow properties. So we're always asking, maybe a little bit more. But in a tough market, we may look at people that are doing $500 and we may try to find a way, how can we get our property on the market for $489? How can we be the best priced property that looks the best so that we can be the property that moves the quickest? So appropriately pricing, it's the same thing on the rental side. It is in the acquisition side. In tough markets, get it occupied or get it priced appropriately so it sells quickly. Final thoughts are evaluate. Measure before you cut. You want to make sure that your cut or when you pull the trigger on this thing, when you make the decision, that your numbers all align. It's worth a second look at everything you're doing in a tight market. I want to thank you for joining me on this episode of the Whitwam Wealth Real Estate Podcast. Be sure to check out our growing list of previous episodes on other real estate investing topics. I invite you to subscribe today and be part of our growing community. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcasts, YouTube, or wherever you enjoy listening to podcasts. This is Scott Whitwam. Be sure to join me on the next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.